Thailand just made a move that most investors didn't see coming. Bitcoin is now officially approved as a regulated derivatives asset inside one of Southeast Asia's fastest-growing capital markets. Futures, options, and possibly crypto ETFs next. But here's the twist. Retail crypto payments are still banned. So why is Thailand opening the door for Wall Street-style Bitcoin products while restricting everyday crypto use? And what does this mean for global institutional money? Let's break it down. Thailand has officially approved Bitcoin as a regulated underlying asset for derivatives trading. In a major development for Southeast Asia's digital asset market, the Thai cabinet has amended the country's Derivatives Act, opening the door for Bitcoin futures and options within the regulated financial system. And that's not all. Crypto exchange-traded funds, or ETFs, are now under consideration as part of Thailand's 2026 capital markets strategy. This move signals something much bigger than a simple regulatory update. It represents a structural shift, a shift toward institutional crypto integration, while retail crypto payments remain banned. So what exactly did Thailand approve? What happens next? How big is the opportunity? And could this put pressure on financial hubs like Singapore and Hong Kong? Let's break it down. Section 1. What exactly was approved? Thailand's cabinet approved changes to the Derivatives Act (BE) 2043. The amendment allows digital assets, including Bitcoin, to be used as underlying assets in regulated derivatives contracts. That means Bitcoin can now legally underpin futures contracts, options contracts, and other structured derivatives products. This does not mean Bitcoin becomes legal tender. It does not mean crypto payments are approved. Instead, it means Bitcoin is being formally recognized inside Thailand's regulated capital markets infrastructure. That distinction matters because derivatives markets are institutional markets. They are used for hedging, speculation, portfolio diversification, risk management, arbitrage, and most importantly, institutional capital allocation. Section 2. Why this matters. Derivatives markets are often larger than spot markets. In traditional finance, derivatives trading volume frequently exceeds underlying asset trading volume multiple times over. When an asset becomes eligible for regulated derivatives, it gains legitimacy, it gains liquidity, it gains institutional participation. Thailand's crypto market is already valued at approximately $3.19 billion, with an average daily trading volume around $95 million. That existing liquidity provides a foundation for a derivatives expansion. But derivatives can significantly amplify activity. They allow leverage, short exposure, hedging for funds, risk-adjusted positioning. In other words, they transform Bitcoin from a speculative retail asset into a risk-managed institutional instrument. That's a major step. Section 3. What the SEC will do next. Now that the cabinet has approved the framework, implementation moves to the Thailand Securities and Exchange Commission, the SEC. The SEC will amend the Derivatives Act, draft licensing requirements, establish compliance standards, define oversight mechanisms, coordinate with the Thailand Futures Exchange, TFEX. TFEX will play a central role in launching actual crypto-linked derivatives contracts. Contract specifications must be defined, contract size, margin requirements, settlement structure, cash settled or physically settled, expiration cycles. These technical decisions will determine how attractive the products are to institutional participants. SEC Secretary General Purnanang Butsaratragun stated that the expansion will strengthen the recognition of crypto as an asset class, promote market inclusiveness, enhance portfolio diversification, and improve risk management for investors. That language is significant. It frames crypto not as speculative risk, but as a portfolio tool. Section 4. Bitcoin futures and crypto ETFs. Under Thailand's 2026 Capital Markets Development Plan, two major products are under review: Bitcoin futures and crypto ETFs. Deputy Secretary General Jomkwan Kongsakul indicated that crypto ETFs could launch early this year, pending legal amendments. If approved, this would make Thailand one of the first Southeast Asian markets to allow spot or structured crypto ETFs under regulated frameworks. Globally, crypto ETFs have proven to be powerful capital attractors. In the United States, spot Bitcoin ETFs have drawn billions of dollars in inflows since approval. ETFs simplify access.
They allow pension funds, insurance companies, wealth managers, family offices, and retail brokerage accounts to gain exposure without directly holding crypto. If Thailand launches ETFs alongside derivatives, it creates a two-layer institutional framework: spot exposure via ETFs, risk management via futures. That combination is powerful. Section 5. Binance Thailand's response. Nirun Fuwatananakul, CEO of Binance Thailand, described the move as a watershed moment for Thailand's capital markets. He stated that it sends a strong signal that Thailand is positioning itself as a forward-looking leader in Southeast Asia's digital economy. This is strategic positioning. Southeast Asia is competitive when it comes to digital finance leadership. Key players include Singapore, Hong Kong, Thailand, Malaysia, and Indonesia. By integrating crypto into regulated derivatives markets, Thailand is signaling institutional maturity, not just retail enthusiasm. Section 6. But crypto payments are still banned. Here's the contrast. While Thailand is welcoming institutional crypto products, retail crypto payments remain prohibited by the central bank. The Bank of Thailand continues to restrict crypto as a payment method. Additionally, in January, the government launched an anti-money laundering campaign targeting crypto-linked gray money. So we see a dual approach: encourage regulated institutional capital, restrict uncontrolled retail usage. This mirrors trends seen globally. The United States regulates crypto securities. Europe implements MiCA frameworks, but payment use cases remain tightly monitored. Thailand is not rejecting crypto, it is compartmentalizing it. Section 7. Economic strategy behind the move. Why now? Thailand's economy is heavily reliant on tourism, exports, regional trade, and capital markets. Developing a modern financial infrastructure attracts foreign investment, institutional capital, fintech innovation, and regional competitiveness. Crypto derivatives do not just attract traders, they attract global funds looking for emerging markets exposure, alternative asset growth, and regulatory clarity. This move strengthens Thailand's capital markets credibility. Section 8. Regional implications. This decision could pressure financial hubs like Singapore and Hong Kong. Both jurisdictions are actively shaping crypto regulation. Singapore has taken a cautious but structured approach. Hong Kong has pushed toward licensed crypto exchanges and ETF approvals. If Thailand accelerates ETF rollout, competition could intensify. Financial hubs compete for listings, liquidity,
institutional headquarters, and asset management flows. Crypto is becoming part of that competitive equation. Section 9. Potential risks. Derivatives increase leverage. Leverage increases volatility. If poorly structured, derivatives markets can amplify price swings, trigger liquidation cascades, and increase systemic exposure. Thailand's regulators must balance innovation with stability. Margin requirements, clearinghouse safeguards, risk controls, these will be critical. Section 10. What to watch next. Key milestones ahead. SEC rule drafting timeline. TFEX contract launch announcements. Licensing framework details. ETF legal amendments. First institutional inflows. Markets will watch